Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we welcome investor at Earlybird VC, Akash Bajwa, to discuss the European venture market. Akash shares his journey into the venture world, starting out working at the Barclay's venture team in London in 2018, before eventually joining one of Europe's oldest VC firms that launched in 1997, Earlybird VC. Akash explains the main difference between the startup ecosystem in Europe and how it has evolved from the early years of venture. We dig into the impact the recent market pullback has had on his firm's existing portfolio investments and how his team's due diligence process has changed in these uncertain times. We also ask Akash to share the impact individuals like Harry Stebbings have had on the traditional venture industry in Europe and what else he thinks needs to be done to bring more attention to the companies being built across the pond. Lastly, we get Akash to share how his firm is planning to deploy its seventh venture fund of 350 million euros into today's markets. But before we get started today, as our listeners probably know by now, the team at Ripple is always focused on helping our founders and portfolio companies find the best partners to work with. And when it comes to corporate finance and cash management, there's nobody we recommend more than the team at Jeeves. At Ripple, we manage all our fund expenses and employee credit cards using Jeeves. The team at Jeeves helped me get my team set up with physical and virtual cards in days. I was able to allow my teammates to expense items in multiple currencies, allowing them to pay for anything, anywhere, at any time. We weren't asked for any personal guarantees or to pay any setup or monthly SaaS fees. Not only does Jeeves save us time, but they also give us up to 3% cash back on our purchases, including expenses like Google, Facebook, or AWS every month. The best part is Jeeves puts up the cash and you settle once every 30 days in any currency you want, unlike some other corporate card companies that make you prepay every month. Listeners of Tank Talks can get set up today with a demo of Jeeves and take advantage of our Tank Talks special with a $250 sign-up bonus and skip the waitlist that already has thousands of companies waiting on it by visiting tryjeeves.com/tanktalks. Use referral code TANKTALKS to get set up today. Now let's jump into the tank for this week's episode with Akash Bajwa from Earlybird VC. Thanks for joining us in the tank today, Akash.
Thanks, Matt. Excited to be here.
Akash, it would be great if we can kick things off with your journey into traditional finance and investing and how you eventually made your way over to startups and tech investing.
Absolutely. So I joined traditional finance, as you said, with a bank, the main bank here in the UK, Barclays. And I joined their ventures team eventually. So where we were co-creating products with other fintechs, also investing sometimes, but mostly partnering. And that was, for me, pretty much an immersion into the world of fintech that was at our doorstep in Shoreditch in East London, which is pretty much still the hub for fintech in all of Europe. When we think about per capita funding in London that goes into fintech. And so that pretty much steeped me in the ecosystem and gave me an exposure to founders, other investors, and the entire, economy being built around fintech in 2018. I sort of caught the bug, you could say, after that, and just pretty much never looked back and was just intent on continuing down that path. And after I left Barclays, I eventually joined Augmentum, which is a fintech fund based in London, investing Series A and later. We were uniquely a publicly listed venture fund, which means that you could actually buy shares of Augmentum on the main market in London. And what we were hoping to do is give investors, retail and institutional, access to the upside of high growth fintechs in the private markets, which are, of course, normally inaccessible for those investors. And in that time, we were investing all across Europe. So I was getting a broader exposure to the European fintech ecosystem. And then most recently, I moved to Earlybird, where I am the main person here in the UK, covering the UK for us, as well as still focusing on fintech across Europe. I'll, of course, hopefully get to tell you a bit more about that, but we are one of Europe's oldest funds. We've been around for 25 years and have had a strong pedigree in fintech as well, including investing in N26 as one of our more successful fintech investments, and insurtech, capital markets as well, right across the spectrum. And yeah, it's been in that time, I've just traversed financial services from the CVC side and now at the very early stage side at seed and pre-seed.
That's amazing. Yeah. And we'll absolutely get into the early bird side of it. But going back to your time at Barclays, you mentioned you worked at the Barclays venture team in 2018 and 19. Must have been a very interesting place to be investing. What were some of the initial misconceptions that you had about investing from within a bank that were quickly put to rest when you started working there?
Yeah, that's a great question, Matt. Thank you. I think it is pretty sensible for a lot of people to have a healthy dose of skepticism about whether the banks are actually still innovating from within or disrupting themselves from within. And I, of course, would also, like a natural consumer, contrast the experience I have with, let's even take mobile banking with some of the high street banks versus the wonderful experience that some of the neobanks have offered, and conclude that this is indeed the case, that that isn't that disposition isn't there. But I was quite pleasantly surprised to see just the caliber of talent that was being deployed towards making sure that the incumbent banks are still agile, able to still have a high level of customer centricity, and still offer products that are matching the level of innovation that their more leaner and smaller counterparts are working on as almost their singular visions. And I guess, of course, what the bigger banks like Barclays had was the trust of customers. In the UK, it's quite startling to see the market share. The bigger banks have 85% of current accounts, so it's clear that there was a lot of reticence to usually switch over to a Monzo or Revolut, especially where the account into which you pay your salary. So people would usually use those accounts for other purposes, but as their core banking account, it was still the case that the big banks were the de facto avenue. With that clear advantage in terms of distribution, they became a very good partner for fintechs. So even if the banks were not going to be as fast in terms of sheer product velocity as the fintechs that were coming out, they at least were very, very sensible partners. And I think that was certainly reflected in my time at Barclays Ventures, where we co-created lots of products with other fintechs. And it's also reflected just in how acquisitive banks have been. I mean, in the US, we have a great example of JP Morgan. They've acquired Nutmeg here in the UK. They've been on an acquisition spree, at least in 2021. And I think if you look at corporate venture capital in general, and you look at the mix of sectors, fintech or financial services institutions acting as corporate venture capitalists still represent the largest share of all verticals. And you see that as strategic investments, where they're purely also potentially customers of some of these companies, but also majority acquisitions as well. And I think that's likely to continue. We're talking about a 20 trillion industry, and that dry powder is still there. These balance sheets are quite big.
Yeah, it's very interesting to hear the way you describe the Barclays, environment that you worked in. It's very similar in Canada as well. With a lot of our, big six banks or five, six banks being the leaders of a lot of the market share, obviously in Canada, just like Barclays and some of the oldest institutions there have been around, soaking up a majority of the market share. However, there have been a ton of partnerships between the financial services industry in Canada, just like the UK, with a lot of startups and the incumbents. But there's always this buy versus build mentality that people always struggle with. And I think what we've seen is a lot of the financial services tend to invest maybe through venture funds or private equity funds to get access to the R&D environment or the up and coming incumbents. But they also try to build internally to make sure that they control a lot of the process. What did you see during your time at Barclays? Were they more into the buy or build mentality?
I think it's certainly something that is also somehow forced. Their hand is sometimes forced by just the processes and the time it would take to build. And so I think that the balance is, there's one which is the ideal state of buying and building purely on the calculus of what is already perhaps a better product, a third party product that can be easily bolted on, versus the investment and time it would take to build internally. But I think it's even exacerbated when you see just the compliance, marketing, and other hoops you have to jump through typically to build internally. The appetite to buy is certainly higher sometimes than the prices at which those acquisitions can happen. So I think the reality is fintech has the most amount of funding of any sector in VC. And so some of these companies that could be potential acquisitions are often at valuations where it makes it very hard for the CEO of a bank to convince his board or his or her board that it would be value accretive to the top line to acquire a company perhaps for the hundreds of millions, if not billions, while still juggling a share price that's still perhaps somewhat neutral or not really trading in line with forecasts. And we know financial services is usually, at least in the last few years, has been certainly before the last 3 months, trading fintechs in their trading performance. And then how can you have the mandate to really go on an acquisitive spree and buy? I think there's not a super black and white formula to this. There's certainly a lot of nuances also when you look at the certain product lines where certain banks are much stronger and certain banks probably have um, a lot more rationale for potentially adding an ecosystem of services that would make their customers even stickier. But in general, I think there's the expectation that there would be a lot of buying is often not really aligned with the reality when it comes to the mandate you could get from a board to actually go out and be this acquisitive. And that truly puts, I think, JP Morgan and a handful of banks in a unique category relative to most banks, particularly in Europe. I think that's less often the case.
Yeah, absolutely. I mean, obviously, prior to the last downturn in the last 3 months or so, companies like Klarna or Affirm were totally inaccessible for an acquisition from some of the larger banks. Maybe, they wouldn't even be able to get approved on an acquisition given how much skepticism there was to, consolidating a lot of the fintech market even more. But nowadays with, Klarna off maybe, what is it, 80% or so, maybe the appetite for getting board approval might have been reemerged. So we'll see what happens there. But you mentioned your time working at Augmentum FinTech, where that was one of Europe's leading venture capital investors focused exclusively on the fintech sector. And given that Augmentum was the only listed fintech focused venture capital firm in the UK, having launched on the London Stock Exchange in 2018, how did being a public company impact your ability to invest or just operate as a traditional venture fund?
Yeah, thanks, Matt. I think it's great to be able to tell this story. I have huge respect for the founders of Augmentum who truly capitalized on what they saw as a need that founders had, which is for permanent capital. And uniquely, the listed vehicle structure allows Augmentum to have what you could call almost an evergreen structure. There's different terminology people use, but what it means is that there's no really restriction on holding periods. And as some of the listeners might know, typically a VC fund has a fixed deployment period and then a fixed harvesting period, and then the fund is wound up after 10 or 12 years. With Augmentum, and they are truly unique, at least as a fintech focused listed fund. But there's even in the broader category of listed VC funds, there's not that many peers. With their structure, if you take capital from them, you are assured that they are far more aligned with you on timelines when it comes to exits and thinking about liquidity events than a typical growth investor or traditional VC fund would be, particularly as it coming in at sort of the Series B or C stage where Augmentum would typically also invest and is probably forecast a certain timeline along which they would hope to materialize some sort of exit. So, as we know in fintech, particularly in consumer fintech, profitability and monetization can sometimes lag the accumulation of a large customer base and the cross-selling of other products and diversification of revenues also typically can be a lagging story. And what comes first is, of course, the customer brand, the NPS, and the customer affinity. And as you build that customer base up and ideally make them quite sticky and the engagement's good, then often, as we see with Starling now, diversifying into mortgages and Monzo's, of course, losses are improving as well. You see the path there where if there were a more patient investor, that can certainly be a far more aligned partner to you. Naturally, we hope Augmentum and I hoped that this would resonate with the founders, that we can be that fintech specialist in a syndicate as well and really add true value add in terms of the expertise that the Augmentum team possessed in previously running fintech companies, but also the bespoke network when it comes to introductions to customers and of course hiring and so forth. The other final point I would add to this is that the way that a publicly listed fund raises capital is also very different to, or at least in many dimensions, is different to how a traditional VC would typically raise capital. So a publicly listed fund raises capital by issuing a prospectus normally, and then like a public company would, and you would then go on a sort of roadshow. Ideally, you would entice a lot of institutional investors. There's a healthy mix. There's a mix of institutional and retail, and you would end up then after a few weeks, basically making the offer live, and you would hopefully hit the target that you had set yourself. But it's a far more truncated process than you would typically see with a VC fund raising over several months or perhaps less time depending on what fund we're talking about, but where it's a slightly more opaque process. You're doing it in one-to-one meetings with funds, with potential limited partners, and those are investing into the general partner as opposed to this being a publicly listed company.
I assume that the cost of staying publicly listed, reporting requirements, compliance, and all those things, the overhead there is somewhat prohibitive as to why a lot of funds would never want to do that. Plus, I assume it traded on a book value, with a market cap of, call it 200 million right now. That's more than the assets under management, but maybe less than what the liquidity value of the company would be if they were to sell. Like, how would you wrap your head around that as a GP all the time? The cost to stay public, but also the discount you would trade to essentially book value.
Yeah, it's with every advantage, you of course make some trade-offs, and perhaps there are more reporting and compliance requirements. But certainly, we felt that that's more than offset by the value that we would confer onto founders by being a partner that is more aligned in the various ways I talked about. That and then that in the end, certainly, if that would allow us to partner with some of those category defining companies, then the overhead that we'd incur in those areas, reporting and so forth, is a pretty small cost item, you could say, towards this revenue generating activity, which is us investing in the best fintech companies emerging in Europe. And to that end, I would say the trading performance of Augmentum shares naturally, of course, follows our net asset value to some extent, which is also reported, or followed Augmentum's net asset value, which is also reported on a frequent cadence. But at the same time, the public market investors, certainly as Europe also matures, and I'm sure we'll talk about this, are becoming more and more patient and broadening and lengthening their time horizons to also price in the upside in these companies that isn't maybe reflected in the net asset value today. And certainly with fintech, at least for the last decade, having been the fastest growing sector in venture, there is a lot of upside, particularly in Europe, perhaps more so than the US, where a lot of that saturation has happened and a lot of those categories are still being built in Europe. And that is something that you can still look forward to and underwrite a case on the back of. That there's a lot more value to be had in some of these companies when they're only at the Series A or B stage, when Augmentum would typically invest. And taking Adyen as an example, which at its peak was a $99 billion company, as far as I know, in the last 2 years has since fallen like everyone, but that is the sort of outcome that Europe can produce. And so when you're potentially looking at a broad portfolio of such assets that could ultimately see that kind of outcome, you have to sort of bake that into the story.
Yeah, absolutely. And I guess the other thing is too, it provides access to the retail investors that may not be able to typically get access to these evergreen fund models who have, amazing portfolio companies that you wouldn't have the ability to get access to through a venture fund model if you weren't meeting certain credit investor criteria and things like that. So I appreciate you sharing that with us. As you mentioned, now finally today, you're with the amazing team at Earlybird VC as an investor. which was a fund, as you mentioned, launched all 25 years ago in 1997 as a pan-European early stage venture fund, and has backed some category leaders like N26, UiPath, OneFootball, Sender, and so many more winners. With 2 billion euros of assets under management, with offices in Berlin, Munich, Paris, and Istanbul, Earlybird is one of the most established and active venture capital funds in Europe. So, can you give our audience a brief history of the European venture capital industry and how has it evolved over the years and some of the main differences between the US venture capital markets and what the European VC world looks like these days?
100%, Matt. I'll do the best I can to do justice to the European ecosystem's history. I'd say a good place to start would be to trace back to the late 90s when Earlybird was also founded. Index Ventures was founded in 1996. Northstone was founded in 1996. Creandum 2003. There was a spate of funds that continue to be some of the leading funds on the continent today that were founded in the late 90s or early 2000s. But what particularly ignited, to my view, some of the dissemination of the founder DNA, the ethos that that Silicon Valley's over so many decades honed and refined for it to be exported to Europe, was the emergence of certain groundbreaking companies in Europe that ended up seeing some of their founders go on to start other VC funds or other companies. And the examples I'd give would be Love Film and Saul Klein. Saul Klein was one of the founders of Love Film. After that business, he helped to set up Seed Camp. Eventually, he also founded Local Globe with his father, Robin Klein, and Local Globe and Seed Camp are two of the most preeminent early stage investors in Europe today. Skype had Nicholas Sennstrom as one of its it's one of its early founders, and Nicholas has now founded Atomico since, and Atomico is one of the leading Series A investors in Europe. And then Message Labs as another example, where this was a business sold for 700 million in the early 2000s, and the founders Joss White and his brothers started Notion Capital, which is one of the leading Series A funds in Europe as well, investing in B2B SaaS. At the same time, in parallel, you had a lot of different bodies or actors that were also propelling the ecosystem forward. Rocket Internet, famously founded in 2007 as this studio that pretty much cloned a lot of successful companies all across the world. And certainly in Europe, they were cloning a lot of companies from the US. And to some respect, this still happens today, but not under the Rocket umbrella. Of course, there's a lot to be said for geographic arbitrage. But certainly at the time, Rocket was derided as being just copycats. But in fact, I think that that was also very important in propagating the DNA of building potentially category defining companies in Europe, when, of course, the culture maybe was still lacking. Several successes followed after that. We had Adyen, TransferWise, Spotify, UiPath. Those are just the ones that have IPO'd at least in these last 15 years or so. All hugely successful companies. And now, if we fast forward to 2021, we had about 100 billion invested in 2021 in Europe. We have over 300 unicorns, over 30 decacorns, and the true inflection is quite hard to appreciate. So, in 2018, we had about $1 trillion in value in all of European tech, and then in those 3 years since, we've gone from 1 trillion to 3 trillion. That escape velocity is quite unbelievable, and there are various factors at play there. One is the influx of capital. There's just never been more money than today, and that's still the case despite the market downturn. The number of U.S. investors that have set up shop and planted flags in Europe. We continue to have some amazing businesses being built here. The ones I mentioned before have already bred a second generation of founders, and this recycling of talent and capital in the form of angel investors, advisors, mentors, and then set repeat founders is this flywheel is well underway. And the governments in some of the major European countries have played a big role in this as well, in that they've really spurred some of the ecosystem building in the form of investing in funds or investing in deep tech where possible. So some of the technologies that some generalist funds were not initially investing in. And that's also been a key factor, as well as the ambition that they set for some of those ecosystems. I think France in particular comes to mind. So today, I think the gap between the US and Europe has narrowed a lot for due to this arc that the ecosystem has been on. And I think that gap will continue to narrow in the coming years. And perhaps the renaissance of European tech is already almost behind us, and we're now sort of in the maturity phase where it's truly appreciated, and there's a consensus that Europe is having this golden age of building, hopefully globally conquering companies in various categories, and all the ingredients are there for that to happen. And certainly, I think that's reflected in just how much capital has come in from all over the world, and some of the just macro statistics that I mentioned.
Yeah, absolutely. I definitely would say, like, being an ignorant North American, I always thought that like European VC or startup ecosystem was a copycat ecosystem of the US with the rockets of the world. But obviously, I was wrong. And there was a lot of innovation and new companies happening constantly. And you have crossed the arc to now be the leader of creating the cutting edge of technology companies and not just being a copycat of what was spun out of the US market. But maybe tell me a little bit about the earliest stages of the startup ecosystem. What is the impact of YC had on having founders leave Europe to go join YC, from, Ireland or from, Paris or Ukraine or wherever, or Turkey. How has that impacted the European ecosystem at the early stage to try and keep talent at home instead of jumping across the pond to the Bay Area that we've seen so many times before?
Absolutely, Matt. I think that's a very important question, because certainly for a lot of founders many years ago, it would have been a far easier path to building a huge company, and to finding the right investors and the right talent by moving to the Bay Area or enrolling in YC in person. I'm glad to see that that's changed dramatically in the last few years, and you can see this reflected in certainly replicas or YC like programs like Entrepreneur First here, which have built some truly enormous VC backed businesses, over 10 billion of value created there by the Entrepreneur First cohorts right across Europe and beyond. We have Antler from which started in Singapore, but also has several offices in Europe. We have incubators in the truest sense. I think I would rather categorize some of those as accelerators with some exceptions, but we have true incubators in the form of e-founders, for example, in Paris, which incubated Spendesk and other unicorns as well. We have one in Germany called Pickus Capital that's also incubated some very, very promising companies. And I'd maybe compare this batch of incubators to someone like a Sutter Hill Ventures in the US, which is essentially also involved in the formation of the ideas and the thesis, and then recruiting the teams to build that. And I think the incentive for talent to stay here has also never been greater, and that's several fold. So, firstly, finding other talent to hire, whether that be across engineering, product, operations, design, people. We've never had such a rich talent pool in Europe. And those are founders or operators coming out of world-class companies in Europe. Some US companies that have European offices, but also increasingly several European world-class companies that have taken some incredible learnings and then can bring them back to very early stage companies. So we have this rich talent pool to choose from, arguably much cheaper talent pool. I think if you compare just the salaries in the US versus Europe, I think that's proven as well. And then you just have also several other tailwinds that are helping folks see this as a base to build hopefully global category winning companies, and that includes, for example, regulation. So in my neck of the woods in fintech, we've had the UK government after 2008 be very, very forward thinking by launching a sandbox where fintechs can pretty much simulate or explore their products in a contained environment without causing any risk to the financial system and to consumers before they ever go live with their product. Then open banking, of course, was also pretty much mandated by the EU and has been enforced across the continent. Whereas in the US, that's been more market driven with Plaid and having to build those integrations with banks one by one. And then you can also just also observe that in fintech adoption. So I think for various reasons, there's more and more belief that you no longer have to leave. The capital is here, the talent is here, and you have all the apparatus around you pretty much to go from the very early days of inception to Series A when you find product market fit. Then growth capital, which used to be a concern that people would have, is also here now. Scalability across the continent, playbooks have been written, all the content has been open source, the literature is out there. There's never been more funds producing this exact type of advice. And that means I believe at least that we're on the cusp of hopefully many breakout companies that will not only become pan-European truly in their market share, not just owning one or two corridors, but then hopefully going beyond and having even bigger ambitions.
Yeah, it sounds like a very similar arc that we've experienced in Canada, except the open banking part. So don't get me started there. So congrats on getting that open. But for us, it's been like seeing Amazon and Salesforce and Uber, Google, Facebook, all of them open up offices, in Canada, just like they've done overseas. And then seeing that talent sort of get, spun out and then going to start their startup has really benefited both of our ecosystems as well. With the pandemic and remote work, people were staying home more. They weren't flying into the Bay Area as much. They were building their companies remotely, and they were also able to recruit amazing talent at more reasonable prices because of the remote work shift as well. Now, I got to ask, what has the fundraising environment and the mindset for founders towards VCs in Europe been like? And what would you say some of the major differences that you've witnessed during your time investing in Europe have been?
Yeah, I think, Matt, this is a question that deserves having its answer be reflected upon every few years, because certainly the evolution in the last few years has been quite stark. I would still say there are some big differences. So one big difference is that in Europe there was a report that came out recent or a couple of years ago that among the European VCs that they sampled, this diversity body, they found that only 8% had former operating experience of any type. Forget founding. What that reveals is the big contrast between US VCs, where at least at this stage in that ecosystem's maturity, several decades in, they do value folks that have previously been in the shoes of the founders that they're backing. And perhaps that's an arc that's inevitable, and maybe that is the true linear path that a tech ecosystem goes down, where the providers of capital are also advisors, in that they've also worn that hat and been in trenches with those founders in the past. But that's also perhaps contradicted by the fact that we've seen the European VC asset class, at least over the last decade, over a 3, 5, and 10-year horizon, outperform broadly the US as an asset class for institutional investors to be allocating to. So whether that's something to be really read into, that European VCs generally have more traditional finance backgrounds and that therefore puts them on the back foot, I don't think that's a very open and shut question to answer. But I think it does also manifest in different ways. So when you think about how founders maybe pitch to VCs in the US, as I would imagine, it's far more product driven, and in Europe, perhaps a demo of the product is maybe an afterthought, and instead there's a bit more of a focus on the analysis of traction, observing the early indicators of product market fit, or if you go a slightly later stage, perhaps a much more granular focus on unit economics and metrics and cohort analysis than the appreciation or affinity of the product, and being very driven by a vision or ambition or this complete obsession that this founder has with changing the world in their worldview. So I suppose I'm contrasting just two different philosophies, and I think that's broadly generalizing, and there's certainly exceptions. And now, as US investors come into Europe and in a truly free market environment where information flows freely, founders have this complete palette of options that they can choose from, and it will be interesting to see if more and more European funds adopt some practices that US funds and US VCs have had and practiced for many years. If that's a more successful style, it's really interesting. We're definitely in sort of a live experiment at the moment as we see different schools of thought and philosophies on venture competing at the same time for the same talent pool, which is European founders, and then those founders having to choose the partners, multiple partners, hopefully that can propel them forward. And so, which pitch resonates more is going to be interesting to watch. And I don't think it's time yet to maybe pass judgment on which approach works and which doesn't. I think we've known with early stage, especially, that there's a spectrum of backgrounds that succeed in venture, and there's also a spectrum of financing partners that can propel a company forward, especially when we truly appreciate the small role we have in these companies being built and becoming enormous. The next few years are going to be quite interesting to see that almost unfold in this petri dish.
Yeah, it's very interesting. It sounds very similar to the way that the American venture capital industry was started and the way that the West Coast versus the East Coast investors operated. West Coast investors would back spin out scientists from, Semiconductor Fairchild and support them on the back of a napkin presentation, where the East Coast investors were more focused on some of the, working prototypes or maybe some of their actual metrics and business, valuations, things like that. And it's very similar to the way that the Canadian ecosystem is started. And it sounds also similar to the way that the European market is. But would you say that you don't see a lot of founders or first time founders with very limited operating experience raising money on the back of a napkin in Europe these days? Or is that starting to change because of the infiltration of the US investors?
Yeah, by the way, I completely agree with that analogy, Matt. And I think as I was reading this great book, which I'm sure you've read also, Power Law, I think that particularly that the way Sebastian made that taxonomy in the 70s is exactly how, at least in the last few years, I saw it. But I think it is changing. So to answer that question now, it is possible for that European founder with perhaps first time founder with with a truly novel insight and in what everyone likes to call founder market fit be quite observable to raise on the back of a napkin. And that's partially because of an influx of US investors, but it's also for other reasons. And I guess a broader framing would be that there's just so much capital competing for this asset class, in that seed, Series A, Series B, all of these stages are heavily, heavily competed. There's far more supply of capital than there are high quality founders that can produce uh, power law esque and outlier returns. And so you're chasing such a small, I guess, cohort of founders, and that has pushed everyone earlier and earlier and earlier. And that compression has pretty much meant that on the back of a napkin pitch will have a sympathetic listener among one of the VCs in Europe, because there are just so many now. And that includes the US investors, that includes the long-standing funds like us, that includes new emerging managers, that includes micro funds, angels, and so forth. So there's this plethora of capital. There are so few founders that will produce that top 10% or top 1% and outcome. And we know in Europe that in terms of DPI, in terms of exits, I think that is still truly rare. That's a forcing function, and then and so this imbalance between supply and demand is forcing people to also invest at those very, very early stages, pre-product. That being said, I would say in this macro environment, things have also attitudes and propensity to invest at those stages has also been affected. But by and large, if we zoom out over the next 5-10 years, I think that will definitely be a far more common occurrence.
Yeah, absolutely. Reading the book Power Law by Sebastian Malaby as well, and it just definitely resonated with me about how our ecosystems have evolved decades later in a very similar way towards the West Coast East Coast ecosystems did in the early '70s and stuff. So glad to hear you reading it as well. Just double clicking on sort of the macro environments with the recent pullback in capital from the markets. How has it impacted your existing portfolio companies? How are you trying to help them manage these uncertain times? And how are you thinking about deploying capital currently in the market? And what are your sort of LPs saying to you at the same time in terms of your deployment cycle?
Yeah, I think, Matt, this is the question of the hour, which is on everyone's mind. There's clearly a realization that these are in many ways unprecedented times. Every crisis is unprecedented in that the combination of factors that lead to it, of course, are quite unique. We have I don't have to probably recite everything, but you have inflation that is rampant. You have stimulus that's being completely curtailed and liquidity being sucked out of the economy. You have consumer spending be very high, but there's an underlying element of credit to that as well. And then if we look towards a potential recession, and I'm certainly no oracle, and it's very hard to make a prediction about this when there's so many geopolitical factors at play as well, that is going to trickle down all the way to early stage companies, let alone growth companies. And I think it's in these moments investors and founders, operators alike appreciate how interconnected everything is. So when the recession happens, you could easily see enterprises slow down IT spend, sales cycles lengthen. You're going to see your sales folks just not hit their quotas. Suddenly, your runway starts to look a little bit shaky because you weren't really accounting for top line growth to stall whilst your burn has stayed steady. And so consumer spend, of course, will also be likely impacted at some point as well. And so if this downturn, how long this downturn is, how severe it is, those are the questions that no one can probably give you can give have an accurate perspective on. But what we can at least do is prepare for our portfolio companies to be able to weather this downturn, however protracted it is. And so that has been a focus for us, where we've been speaking to our founders, examining the state of the company, where they are on their roadmaps versus what they planned, what we probably expect the fundraising market to demand of them when they go out to raise, whether that's for a Series A, B, or seed, and so forth. And as such, determining where we need to support them a little bit, maybe inject a little bit of capital or not. Maybe it's just about planning and thinking about the hiring roadmap, thinking about the go to market in a more focused way to show some early traction that can continue the momentum and hopefully attract the follow on financing. And that's definitely a key risk that we also look at now with new businesses that we could invest in. So it's just making sure that our portfolio is battle proof and largely the vulnerability is reduced to however long the downturn is, and that's again, I guess I would call the completely unpredictable factor here. With new investments, I think there's several ways of looking at it. The positive way is that we have more time to do due diligence. We have valuations that are resetting to historical norms, and so it's better for everybody. And I know that that may not seem like it's so obvious to founders, but when it's articulated in a way that shows how founders are going to be able to benefit from a much closer alignment of expectations versus reality when it comes to valuations, and what we're seeing in the public markets as those being the real clearing price of a company 10 years in. If you're looking to build a 100 million ARR company, that is what people are expecting of you in terms of EBITDA margin, free cash flow, and so forth. Now, obviously, at the outset as a founder, you don't want to be thinking about all of those peculiarities. You're thinking, at this point, I have a problem I want to solve. I have a burning desire to solve that problem. But it is important to appreciate that that is how public markets will price your company potentially down the line. And so where we're able to help them appreciate that this valuation reset is a good thing because you can grow into your valuation, you can grow at a pace that's more manageable and actually deliver results that Series A, B, C investors will invest off the back of. That's the rhetoric that I think we're adopting. And so with new investments, it's just a focus also on examining the unit economics and appreciating that this company has a scalable business model. There's a lot of capital intensive business models that were funded in the last couple of years that I think are going to find it very hard maybe to sustain that growth in this market. And so yeah, there's been I think there's a focus also on company building, whilst with new investments, just taking the long term view, which we should always have had anyway, of building truly sustainable companies.
Yeah, it makes a lot of sense. And we're saying the same thing to our portfolio companies. And I think also like capital efficiency is key. I think that's a mindset thing we've had in Canada for quite some time, just because we haven't had access to a lot of the US capital. Like I'm sure a lot of the European founders have thought about building their companies. So that makes a lot of sense. I got to ask though, what is the impact of sort of these solo GPs or kind of Twitter VCs like Harry Stebbings had on the ecosystem by bringing more attention to the European venture capital ecosystem? And what do you think needs to be done to bring more attention to the companies being built there?
Thanks, Matt. I think it's really hard to overestimate the impact that folks like Harry Stebbings have had on Europe. So I can tell you, I was one of the early. Well, I was definitely a listener starting out in VC, and it's probably hard to put a number on how many folks he's educated, Harry and others on Twitter or podcasts or Substacks that have democratize this practice and this craft for apprentices and students to study in their own time and to study the greats and study the wisdom that can be passed down from the great investors of the valley all the way down to European junior investors starting out their careers, as well as the folks that have then risen through the ranks to become partners. So this dissemination of that knowledge from the US to Europe has been a great force for us having hopefully a far more ambitious mindset. I'd say that there's still a lot of work to be done, I think, to just cast a sharp light on the inflection we've seen in Europe in the last few years. So, despite there being a lot of content now around the European ecosystem's renaissance or inflection, with all this money coming in and having so many investors that have strong brands, I think we're still a very early stage of seeing many solo capitalists, for example. Harry and 20 VC are one of them, and there's maybe a handful more that I can think of. But compared to the US, we're many, many years behind. We still have yet to see, in my opinion, several vintages of world class category defining companies, and the names I mentioned earlier on in our conversation, Matt, such as UiPath and Adyen and Spotify. These are great names that we can all be proud of, but I want Europe to be producing such a cohort and batch of companies more frequently, so that the lack of awareness about what Europe can produce and the stereotypes people have, those can be easily disposed of. And when I look at fintech, I think there are many efforts being attempted at this, and Checkout and Adyen are jostling with Stripe when it comes to payment processing. In merchant acquiring, we see SumUp and SaltPay, both still private companies competing with Square, for example, in Europe. N26 and Revolut, as some of the biggest neobanks that emerge out of Europe, are taking at least initially expanded to the US as well, but are also taking on competitors beyond Europe. So there is a global ambition that's also growing year by year. And as some of those companies then truly break through and have those watershed moments, hopefully we'll have just far more brand recognition and appreciation for Europe being a potential starting place for such outcomes. But just to finally finish that point, I think there's truly a great white space folks to build personal brands in Europe, and Harry Stebbings has done that really well. And hopefully, we'll see more independent creators build great distribution engines and continue to hopefully earn that goodwill and reputation by providing true value to the ecosystem. And what he's done is already wonderful. And I think folks who are able to add value in other ways, such as talent support and so forth, or focusing on specific niches like go to market, I think there's huge space for them to enter Europe and carve out a niche.
Absolutely. I think the democratization of startups, technology, and venture investing is what everyone needs, and that's what we're trying to do exactly with this podcast: is give people insights into specific problems that they need help solving, instead of just giving a historical view of sort of like how a company was built from the 1980s. Because there's a lot of problems that still need to be solved, and there's a lot of mind share that can go around to help a lot of founders and operators figure out this journey, and they don't have to do it alone. So thank you for sharing that. Earlybird, as you mentioned, is one of the oldest VC funds in Europe, has recently closed its seventh early stage fund with a hard cap of 350 million euros, making it one of the largest European early stage funds. Can you tell us a bit more about where this fund is planning to invest now and how founders looking for capital should be best to get in touch with you and your team?
Yeah, thanks, Matt. It's great to be able to invite any founders listening here to reach out to us by contacting us on our website or our LinkedIn's. We're all very friendly folks, so please do reach out. So we've always been a generalist fund, and that means that we have specialism internally between our investment team, but you can get in touch with us about pretty much any problem you're thinking about solving or any markets you're tackling. I'd say our pedigree historically has been in areas like enterprise software, fintech and insurtech, and definitely deep tech, where we, I think, definitely uniquely stand out to the rest of the market. That being said, we've invested in some great consumer businesses. We've invested in logistics. The list is truly endless. So, what we bring to founders across all these domains with our vertical specificity inside of our team is this DNA of building companies from the very early days to get to product market fit and then to scale. And we've that's been our bread and butter for 25 years, and that's where we've had success over multiple unicorn journeys and trajectories. So that's the blueprint or playbook, you could say, that we've refined over those years, and that we can lend to companies across sectors.
Yeah, it's that playbook, I think, that has given you, so much recognition and respect probably from your LPs and partners for so long, which is great. And I wish you all the best with your newest fund, investing in this current market. Now, before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
Yeah, it would be Invest Like the Best with Patrick O'Shaughnessy.
Fantastic one. Second, favorite newsletter or blog.
It would be the blog of Redpoint GP Tomasz Tungus for all things B2B SaaS.
Fantastic. Favorite tech gadget.
Pretty lame answer here, but I'm going to go with my Kindle. I've just recently been discovering more features like sharing snippets from a book with people directly over email. So I'm a boring bookworm, and I love my Kindle.
No, that's a great feature. I do audiobooks, and it is hard to share the snippet. So I always have to listen to it, write it down, and then share it as a Slack message to our team or something.
Yeah, and you forget otherwise.
Exactly. Favorite new trend?
I'm quite a big fan of the proliferation of content creators, what we were just talking about at the end with Harry Stebbings. I think that's quite exciting to see that there are more independent writers on Substack, more independent podcasts, and folks breaking out from incumbent, maybe bloated empires and building a personal brand around the unique voice that they have. And I really love devouring exactly that type of content on Substack and Medium and so forth.
Absolutely. Seeing, people leaving the New York Times and Wall Street Journal and Bloomberg to write out their own Substack is going to be an amazing trend to continue to follow and bet on. Favorite book?
It's going to be Guns, Germs, and Steel. And the reason for that is that I think, like myself, a lot of people often reflect on why the world is the way it is in terms of, let's say, economic disparity between the West and the East, or Asia, Africa, and so forth. And there are many causes you might hypothesize as being the main reasons, but actually, Guns, Germs, and Steel presents this very fact-based and evidence-based account or argument for it being quite geographically deterministic. And so you'll hear in this book, or if you read in this book, a pretty compelling narrative of how specific local conditions when it comes to the soil, for example, or the climate in certain parts of the world meant that other areas were more civilized and became more sophisticated faster. And then, of course, were able to produce guns, germs, and steel, or were able to become more technologically advanced. And that account, I think, for me, just brings a bit more coherence to the way I think about history.
It also, Gus, has a relationship to like venture capital investing and why people think market is the thing that matters 90% of the time. Like external factors, the market really do determine a lot more than you take for granted. And just like the guns, germs, and steel, the same analogy.
It's exactly that. And as you say, Matt, this is the principle that Andy Ratcliffe would talk about when it's a good team, but a bad market. It's the market that keeps its reputation.
Absolutely. And last but not least, your favorite life lesson.
Yeah, this is a lesson that I try to live by every day, which is just to put goodwill out there into the world, and you never know how it'll come back to you, but never to have expectations. And so I think the more you do that, the more you believe in karma, you'll be surprised how many times the universe will, in some magical way, reward you that just leaves you with a smile on your face.
Thanks for joining us in the tank today with Akash Bajwa, partner at Earlybird VC.
Thanks, Matt. It was great to be here.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,